Hello and welcome to another Quantum Traders video. In this video we're going to talk about direction and how you can look at a chart in under 10 seconds and decide which way you're going to trade. And I'm going to take you through those steps. So the first things you're looking for as a trader is you want to understand which way is the market pushing. And you can see on Bitcoin here, just over the last couple of days, we're actually pushing pretty strongly to the upside. You can see that's a very powerful move. So let's say that you were thinking to yourself, the market's been going up and you don't want to buy at this point here because it means you're going to be stuck and the market's possibly going to pull back against you, maybe even taking your stop. So when you see a long move like this, the first thing you need to do is you need to actually sit and wait for the market to go into a range like this. And what we're going to do is enlarge this little range a little bit more, because from this range we're going to get a lot of information about how to find where we should trade. So what does a contraction phase look like? And at its very simplest, although it can be much more complex than this, you will have at least 3 points in a contraction phase. There might be 2 highs in this case and a singular low, and that is enough for you to actually determine that that market's in a contraction phase. Now once we've got that, we know 2 things. We know, number one, that the trend direction is up. We know that this contraction phase is not going anywhere, and the question is, why is that not going anywhere? And the reason is because that's where fair value is at this moment. Now a lot of traders will get stuck in this contraction phase. They'll be trying to sell the top and buy the low, and as you can see, they would have got stopped out. So how do we use the contraction phase to actually help us in finding which way we need to trade? And I'm going to do that now. So the first thing to do with the contraction phase is to simply put a box around it, because once you put the box around the contraction phase, you know where fair value is, and fair value is actually just the middle of the box. So that's excellent, because we know that as that's fair value, that even if the market moves away from that point, it should come back to the fair value. And indeed, that's exactly where it came to. Now, let's say that you saw this sideways market develop and you wanted to buy this low. Would that be even possible? And yes, I can show you it would. And I'm going to show you how to do it. Now you've got a couple of options that you can use. First of all, you can read books about candlesticks and you can correctly identify what candle pattern that is. I've got no idea, but if you were a candlestick reader, you could see that there was clearly demand coming in here, because even though that was a down candle, it had a long wick, the next candle was an up candle. But if you had another way of reading liquidity that was all the time accurate, didn't involve any subjective evaluation of the candles, you would have come up with something like a liquidity map. And I'm going to put that on the chart now, but I'm going to show it to you as we originally devised it. And this is, it simply shows you a value of each of these candles and how much liquidity is actually resting there. Because liquidity is really the only thing that the market's going to react to, this indicator actually shows you the liquidity forming in the actual candle itself. So this candle here had a value of 181. This next candle, the black one, was 4,320. So as this market's moving down, we can see that liquidity is increasing. And finally, on this candle here, we get a value of 35,934. Now each of these candles has an associated liquidity value. It's just a bit small, so it's a bit hard to read. That's why I reproduced them here. But we can also show this in the form of a histogram, and that's exactly what the histogram map shows you. I'll put that on the chart now. So you really want to get interested in taking a trade when the liquidity peaks, and you can see that according to the histogram, it's just reflecting the values generated by each bar, but that's where we've got our peak. And on the next candle, this candle was slightly lower which means that there wasn't as much liquidity. So if liquidity is what causes the markets to turn, then clearly when you have high liquidity followed by low liquidity, the chances are that you have a turn in place. That's how you can actually hit these turns with a degree of confidence that I haven't seen with any other indicator I've looked at. Now, the liquidity map and the liquidity histogram are very similar in what they do, but they both can tell you a different story. The liquidity map actually shows you inside the candles where the liquidity is. So you can see in this big candle here, you want to know where the liquidity is, because if Bitcoin comes back down into that area, where might it bounce off? And I can see very obviously that that's the top of liquidity. So I can put a line there. Similarly, there's no liquidity here. So I know the market's not going to be interested in going into this area because there's no liquidity there. The last place there was real liquidity was just here. And that's why this market, when it fell out of the fair value gap, came back to that point, because that's where liquidity was. Now, the great thing about this indicator, you can put it on any time frame and it will give you incredible results. The thing is, if you use it on the hourly time frame, you can often set levels like this one and this one, and these levels are really useful when you want to come and trade on a 5-minute time frame. So let's have a look what this chart would look like on a 5-minute time frame. So as you go down the time frames, you get a degree of granularity that you don't get on the hourly chart. We would have marked this level because it was a good level on the hourly chart. We could have seen that was good. We also would have marked this level because that was also another good level on the hourly chart. If we look at the histogram, however, we can see that the histogram was, as we came into this fall here, we see that the histogram was higher than any of the previous levels all the way back there. It was higher than that one, that one, that one, but not higher than that one, because that one was actually a turn. So we know as we came up into this level and the histogram printed that we could have anticipated that turn would have actually occurred. Now, I like to look for a certain combination of candles when I trade this histogram and map together, and those candles are aqua and dark blue, fire brick red and purple. If I see those colours, I have a very good idea that I'm looking for a change in trend direction. So coupled together with the histogram, that would have been a no-brainer trade for me. The question is, if you were using something like CCI or MACD or RSI, would you have actually got this turn? I can see that the histogram only gave us one signal, but if you'd been using CCI, let's say, you would have got a buy signal there, you would have got another buy signal there. So, okay, so both of them have failed. Maybe you would have taken this as your buy signal. You would have said, okay, we've gone lower, a little bit of divergence there. So you would have maybe thought, I'll get in there. Again, you would have been stopped out. The only time the histogram gave you a confirmed signal was there. And if you look at the CCI, yes, we did get divergence there, but we would have had at least 3 entries, which all would have failed. So if you're using old indicators from the 70s, you've got to really forget them, because they are not going to help you make money in trading. You need tools which are up to date and can help you take on the markets and make money, because otherwise you might as well just not even bother trading. And that would be my advice. If you do not invest in your trading tools, you just won't succeed. Now, if you can read candlesticks, yes, maybe, because that's what our liquidity indicator is actually doing, it's reading the candlesticks, you might have been able to spot that. I don't know, I couldn't, and I've been looking at charts for a very good long amount of time. Well, if you like this video, please like and subscribe and join our Discord group. The link's in the description below. Thanks very much for watching, and see you next time.